Let's unravel the world of the corporate investment banking, starting with its definition, the crucial concept of financial bridge. A corporate investment bank, a key player in the financial landscape, is a specialized institution that caters towards corporations, governments, and institutional clients. Its array of services includes facilitating complex financial transactions, raising capital through IPOs and bond issuance, and providing expert advisory services for mergers and acquisitions and strategic financial decisions. Imagine a financial bridge, a connection between those seeking capital, like corporations and governments, and investors eager to invest their funds. This is where the corporate investment bank steps in as a maestro of finance, guiding a flow of capital to match the needs of corporations with the preference of diverse investors. With precision and expertise, they ensure that financial notes resonate harmoniously, facilitating deals and creating opportunities and foster economic growth. In essence, the corporate investment bank is the financial bridge, uniting aspirations and investments, steering the path of prosperity in the symphony of finance. Let's dive into the intricate world of the corporate investment bank, exploring the diverse range of financial services it offers. First, we have capital raising. Capital raising involves helping corporations secure funds to finance their operations, projects, or expansions. Corporate investment banks play a crucial role in this process by facilitating the issuance of stocks through initial public offerings, IPOs, or issuing debt securities like bonds. IPOs. An IPO is when a private company decides to go public by selling its shares to the general public for the first time. Corporate investment banks help companies navigate the regulatory requirements and assist in pricing and marketing the shares to potential investors. Bonds. Corporate investment banks also help corporations issue bonds, which is a debt security that companies sell to investors. In return, the company promises to pay periodic interest and repay the principal amount at a predetermined date. Next, we have mergers and acquisitions advisory. M&A advisory involves providing advice and assistance to companies engaged in mergers and acquisitions and other corporate restructuring activities. Mergers. A merger occurs when two companies decide to combine to become one entity. Corporate investment banks assist in valuing the companies, negotiating the terms for the merger, and providing strategic advice throughout the process. Acquisitions. An acquisition happens when one company purchases another. The investment bank helps with due diligence, identifying potential target companies, and structuring the deal. Next, we have sales and trading. Sales and trading is a core function of corporate investment banks, involving buying and selling various financial instruments on the behalf of clients or the bank's own accounts. Financial instruments. These financial instruments include stocks, bonds, currencies, commodities, and derivatives. Traders on the trading floor execute trades to capitalize on market opportunities and provide liquidity to the financial markets. Next, we have research. Research teams within corporate investment banks conduct in-depth analysis of financial markets, companies, and industries to provide valuable insights to clients and traders. There are two types of research analysis. Market analysis. Analysts study market trends, macroeconomic indicators, and global events to forecast market movements and identify potential investment opportunities. Company analysis. In-depth research on specific companies provides valuable information on their financial health, performance, and growth prospects. Next, we have risk management. Risk management services offered by corporate investment banks help clients identify and mitigate potential financial risks associated with their operations and investments. Risk identification. The bank assesses various risks such as market risk, credit risk, liquidity risk, and operational risk to help clients understand potential vulnerabilities. Risk mitigation by offering risk hedging strategies and financial instruments like derivatives. The banks helps clients protect themselves from adverse market movements. Next, we have corporate finance. Corporate finance services involve assisting corporations in making strategic financial decisions to optimize their capital structure and financial resources. Capital structure. The bank advises companies on the best mix of equity and debt financing to achieve their financial objectives while managing risk. Financial strategy. Corporate finance experts collaborate with companies to develop financial strategies that align with their long-term goals, such as expansion, investment, or debt reduction. Finally, we have asset management. Asset management services provided by corporate investment banks cater towards institutional clients, high net worth individuals, and funds, offering expert management of investment portfolios. Asset managers allocate investments across a diverse range of assets, stocks, bonds, real estate, etc., to achieve the client's financial objectives while considering their risk tolerance. Performance monitoring. They continuously monitor the portfolio's performance, making adjustments as needed to optimize returns and manage risk. So, who are typically the customers to corporate investment banks? Large corporations seeking funding for expansion or day-to-day operations. Governments raising capital for infrastructure projects or to finance budget deficits. Institutional investors, hedge funds, mutual funds, pension funds looking for investment opportunities. High net worth individuals seeking personalized financial advice and investment solutions. Impact. Corporate investment banks play a crucial role in the global economy. They enable corporations to grow and innovate, create jobs, and contribute to the economic development. By providing financial solutions and capital to companies, they support entrepreneurship and encourage economic growth. Corporate investment bank operates within a heavily regulated environment. These regulations are put in place to ensure financial stability, protect investors and clients, and maintain market integrity. However, navigating through this regulatory landscape is no easy task. The industry must stay agile and adapt to ever-changing requirements, which pose significant challenges. In a fast-paced and competitive environment, corporate investment banks also face market volatility. As financial markets fluctuate, it becomes crucial for these institutions to manage risk effectively, both for their own sake and that of their clients. Moreover, clients' demands for innovative financial products and services have grown. To remain relevant and competitive, investment banks must continuously innovate and develop cutting-edge solutions that meet their clients' evolving needs. The corporate investment banking industry has not been without its fair share of criticism and public scrutiny, especially following the 2008 financial crisis. Some perceive these institutions as overly profit-driven, and concerns have been raised about conflicts of interest and risk-taking behavior. However, it's essential to recognize that the actions of few do not represent the entire industry. Many corporate investment banks prioritize ethical practices and work diligently to build and maintain trust with their clients and the public. Beyond the criticisms, corporate investment banks play a vital role in supporting businesses and infrastructure projects that drive economic growth. By facilitating the efficient allocation of capital, they enable investors to participate in various sectors and industries, fostering growth and prosperity. These institutions are the financial intermediaries that connect companies and government with investors, paving the way for innovation, development, and progress.